Welcome to Executive Outcome YouTube channel. My name is Michael Mwansaliova. We are going to look at a worked example under cash budgets part 3. This example is a typical examination type of question, and I'm going to show you how you approach such questions which normally carry a number of notes to be considered. Assume you are the financial manager of a small retail company. The company operates on a monthly budgeting cycle, and you need to prepare a cash budget for the upcoming second quarter of 2023. Based on the following information, calculate the ending cash balances for the 3 months in the second quarter of 2023. And we are going to look at the number of these notes in actually answering this question. The best approach I've advised students over many years of my teaching is, when it comes to cash budget preparation question, you have to look at how best you can maximize your marks and efficiently gain those marks through an appropriate presentation. So the appropriate presentation is to start with a template of a cash budget. So you should master the template of a cash budget. In the part 1, I did explain or show you a typical cash budget template, which looks at the following components. 1, it reflects the cash inflows. It also looks at the cash outflows. It also shows a net cash flow. And then you're going to look at the opening cash balance as well as the closing cash balance, in that order. So once you have put a template, that template should occupy the whole page. You know, when you're writing an exam, you start a new question on a new page. So the whole page which you are going to start this question relating to cash budget should be reserved for the template or the format of the cash budget. Then the subsequent page following that one should be reserved for workings. Don't start with workings then go to the template. The reason is you might not know to what extent the workings will cover the pages. So that's why we advise, or I advise, that students start with the template, then they follow it with the workings. So let's look at how you approach this question. In this question, there are low-hanging fruits which you can start with as you are preparing to start cracking on the workings. So low-hanging fruits are those marks which are collected just by looking at the question and picking out a figure which you can easily slot into the template. Some of these include, for instance, if you look at this particular question, you are given under notes to say the beginning cash balance in March 2023 is 15,000. So that does not require much thinking, so you just pick it and go and slot it where as opening balance under the month of March. Equally, then the next point, which is in April 2023, insurance claim expected to mature amounting to 10,000. Again, that is another low-hanging fruit. So let's see where these are being slotted in the template. So this relates to the income side. So we have the insurance claim 10,000, the government grant 100,000, disposal proceed 20,000 in June. So those are low-hanging fruits which you actually collect. So our focus is to see how we do the workings so that we generate these figures needed by this particular template. So let's look at these notes and look at how they are treated. Like before, you have rental expense, which is 5,000. This one goes under a cash outflow. You have utility bills amounting to 1,500 per month, which also goes in the outflow section. You have miscellaneous expenses per month, 2,000 kwacha. These monthly expenditures, let's see how they are slotted. So under the cash outflow, we have the rental, 5,000 April, 5,000 May, 5,000 June. We have utility bills, 1,500 in April, 1,500 in May, 1,500 in June. Equally miscellaneous expenses, 2,000 in April, 2,000 in May, 2,000 in June. The other one which follows is the acquisition of new machine that costs 150,000 in February 2023, where a deposit of 50,000 is paid and the balance is paid in the following 2 equal monthly installments. So meaning that if the purchase of the new machine is expected to be February, then 50,000 will be paid in February itself, then the other 50,000 will be paid in March, and the third 50,000 will be paid in April. So when you look at our cash budget, since the cash budget for the second quarter, it simply means that we're going only to capture the 50,000 which relates to April here, because the other 250,000, one was paid in March, the other one was paid in February. So the figure of relevance here is the 50,000 only that is going to appear in April. Let's look at the next note. Loan repayment as at the close of January 2023. The principal is 2,000, the interest 500. Then we are guided that the principal and interest is expected to be reducing by 10% on the outstanding balance each subsequent month. So how do we treat this one? Because of the computation is extensive, it needs a working. So let's look at the working for loan repayment. Okay, so in January we are guided is 2,000 principal and 500 interest. Then we are told that this will be reducing by 10% every subsequent month. So mean that come February, the 2,000 reduces to 1,800. You remove 10% of 2,000, which is 200, you remain with it, 1,800. Equally for the interest, from 500 in January, 10% reduction, which is 50 kwacha, it will remain with 450 in February. Coming to March, again we reduce that 1,800 to move to March figure. We find that 10% removed and we remain with 1,620. Equally for interest, which was outstanding at 450 in February, we reduce it by 50%, which is 45 kwacha. We are going to remain with 405. This trend continues until June. Now, because we are looking at a second quarter, means that we are only worried with April, May, and June. So we want to know how much for these months was payment relating to loan. So we add the principal and interest. Under April, we are going to have 1,822. Under May, we are going to have 1,640. And in June, we have 1,476. These are the figures which are going to slot into our cash budget template coming from this working. So go to the cash budget template. On the outflow side, we have loan repayment as given, and you are going to show that these figures are coming from working two. So 1,822, 1,640 for May, 1,476. Let's look at the next note. This note number 10, we are advised the 100,000 expected to be received as a government grant in May. That was shown under the income side. The 100,000 which is supposed to be received in May, here it sits under May. Then we also have overheads in January 2020 are expected to be 40,000 to include 10,000 for depreciation. The amount net of depreciation is expected to increase at 10% for each subsequent month. Overhead obligations lag by 1 month. Okay, so now here is a catch. Within the 40,000 kwacha, okay, overheads in January, that 40,000 kwacha includes 10,000 which is depreciation. Now don't forget that we are dealing with a cash budget, which is a projection of cash movements, actual cash movement, cash inflow and cash outflow, physical cash inflow and cash outflow. Now, depreciation is a non-cash item. It's just a book entry in our books of business. So, since it's a non-cash item, we have to exclude it from 40,000, which leaves us with only 30,000 as a cash flow, actual cash flow. And to that 30,000, which we are referring to as the amount net of depreciation, we are guided that it's expected to be increasing at 10% for each subsequent month. And then when it comes to paying, the obligations lag by one month. Okay, so let's look at how we work out this one. Loan repayments, no overheads. Now for overheads, we have the net amount, which is 30,000 in January. Now when it comes to February, this 30,000 will increase by 10%. So 10% of 30,000 will be 3,000. Okay, meaning that we are going to have a total of 33,000 in February. Okay, 33,000 in February. So come March, we are going to have to start with 3,000 kwacha, which is going to increase again by 10%. The 10% of the 3,000 will amount to 3,300, meaning that in March we are going to have a total obligation of 36,300. In April, we start with 6,300, which is going to increase by 10%. 10% of 6,300 is 3,630, meaning that in April we are going to have a total overhead obligation of 39,930. In May, we start with 39,930. It increases by 10%. We are going to have an increment of 3,993. Therefore, in May, the total obligation comes to 43,923. Now, we don't need to compute the June figures, because when it comes to payment, the payment for overheads will be lagging by 1 month, meaning that the obligation of March will be paid in April. The obligation of April will be paid in May. The obligations of May will be paid in June. So that's what we consider going by the note. So we're going to see how overheads will be shown in the cash budget. So overhead, you can see 36,300 in April. The May takes a hit of the 9,930 on account of overheads, and then the June takes 43,923. Then we look at table 1. That has to do with our sales projections. Our sales projections. Remember, I did discuss with you the factors that you need to do to consider when making sales projection or a cash inflow projection. I discussed that one under part 2, cash budgeting. So if you have forgotten, please go back to my YouTube presentation, cash budget part 2. So here you have the projections. We have January through June, those figures. Okay. Then we are given to say 20% of the sales are cash. The balance are credit sales. The balance are credit sales whose pattern of payment by debtors are 40% in the month following sales and the balance in the month following. Now here, the balance in the month following, the last point, is relating to 60% because this is relating to credit sales. Once you remove the 20% cash sales, the balance are credit sales, and these credit sales are the ones that are being referred to here. We assume that we are taking that 40% of that as guided will be paid in the month following sales. Then of the credit sales, what remains when we remove 40% is 60%. So let's look at how this is done in workings. So we have to reflect the cash, the sales projections, which is 100,000 in January through to June with 140,000. So we are guided that of the total sales projection, 20% are cash, are on the basis of cash. So you calculate 20% of that month's projection that is expected to be paid in cash. So 100,000, 20% will be 20,000 kwacha, leaving the credit sales of 80,000 kwacha. Equally, for February, the projection in sales is 80, and then you have 20% cash sales, which is 16,000, leaving 80%, which is 64,000. So I've taken note of how much of the total projection are on account of sales. So meaning cash sales, meaning that the same month of sale, you receive that money. The question is, how do we receive the balance, which is the credit sales? In the balance, we are given a note that 40% are supposed to be received in the month following sale, and the balance in the month following to that. So this is how we are going to proceed with this. So let's look at the next slide, where we see how the credit sales are supposed to be received. So it falls under receipts relating to the same and split into 40% and 60%. As per note, 40% is money going to be received from these debtors in the month following the same month of sale, and the balance in the month that follows. So meaning if you look at 100,000, which is sales in January, projection sales in January, so the 80,000 that remained here, this is how it's going to be received. 40% in the month following sale, following month of January, we are going to get 40% of the of 80,000 credit sales, going to be 32,000 kwacha in February. That is the month following January. Then 60% in the month following. The month following to February is March, so that will be 60% going, which is coming to 48,000 out of the 80,000 coming in March. Let's look at the projections in February. Out of the 80,000 total sales projections, we are saying 20% is going to be received in February itself out of the 80,000 sales projection. Then that leaves us a balance of 64,000. Out of the 80,000, we remove 16,000, remain with 64,000 on account of credit sales. So how is this credit sales 64 going to be received? So again, 40% will be received in the month following sale. The month following sale for this January sale will be March. So 40% of 64,000 comes to be under March. Okay, which will be 25,000. Then 60% out of 64,000 will come under April, which is the month following March, which is 38,400. So you slant it like that. You go to March sales projections 114. You knock off the 20% cash sales, which is 28,000. 40% of 140 is 28,000. Leaves you 112,000 as credit sales. So how is this money going to be received? So again, we are guided. It is 40% in the month following sale. Month following sale of March sales is April. So 40% of 112 will be received in April. So 40% of 112 will be received in April. 40% of 112 will be 44,800. And the 60% received in May, which is 67,200. So this is how we continue until we reach June. So now, because our cash budget is for a second quarter, which covers April, May, and June, we just bother ourselves with coming up with a total for April, May, and June. That is, in April, we expect to get a total cash and credit receipts of 107,200. In May, 131,600. In June, 127,200. So let's see how we slot them in. So you have to look at the working number. This is part of the inflow. So we're going to show that this is under, say, working 107,200 and 131,600 in May and 127,200 in June. You guide the marker where you're getting this figure from. So you show the working under which you showed these particular figures. I believe that covers the cash inflow. We look at the cash outflow workings, particularly the purchases. So let's look at what is under purchases workings. Again, you show your projections, purchase projection of 60,000 through to June with 80,000. And then in the note on purchases, we are guided that when it comes to payments, 10% of the total cash purchases projection will be made in the month of purchases, 40% in the month following, and 50% in the month following to that. If you add this, it gives you a total of 100%. So we go to the workings, which demonstrates how we arrive at these figures. So these are the 60,000, 50,000, 100,000, 80,000, 100,000, 80,000 purchase projection from January through to June. So we are bothered about the payments. How are the payments going to be made? So 10% in the month of purchase. So out of the 60,000 January expected purchase, we expect 10% of that to be paid in the month itself. So that's a 10% of 60,000. We have 6,000 in the month of January itself. Then 40% of 60,000 should be paid in the month following. So 40% of 60,000 will give you 24,000 in the month following, which will be February. Then 50% of 60,000 in the month following means that 50% of 60,000 will pay the month following, which is March, which is 30,000. You can have this 10% 6,000 in January itself, 24,000 in February. February following the month of purchase, then 30,000 in the month following, which is March. So that's how that 60,000 will be catered for. We come to 50,000, which is the projected purchase in February. Similarly, 10% of 50,000, 5,000 in the month of February itself, 40%, which is 20,000 in the month following, which is March, then 30%, which is 25,000 in the month following March, which is April. We come to March. The projections for purchase are 100,000. 10% of 100,000 in the month of purchase itself, which is 10,000 here. Then 20%, again we get 40%, which is 40% of 100,000, which is 40,000 coming to the month following March, which is sitting here 40,000 kwacha in April. Then 50%, which is 50,000 of 100,000 kwacha, which comes to sit in the month following April, in this case May. So we have 10,000, 40,000, and 50,000. Similarly, when it comes to April purchases, 80,000, 10%, 8,000 in the April itself. Then 40%, which is 2,000 in the month following April, the month of purchase, which will be May, which is here 32,000. Then 50% in the month following to May, which is June, we are going to reflect 40,000 there. The similar pattern will be observed for May and June. Like before, since our quota involves April, May, and June, we only bother ourselves to add up the total payments for May, April, May, and June, which comes to 73,000, 92,000, and 88,000 as the expected cash outflow emanating from purchases. So let's see how that is reflected in the template. So purchases, you have 73,000 in April, and 92,000 in May, and 88,000 in June. Don't forget to indicate the working number where these figures are coming from in the exam. So when you look at that, we have taken care of all our cash inflow and all our cash outflow. So it's time to look at the total cash outflow. So the total cash outflow, we add all the figures in each month. Under cash outflow, we find that in April, the total cash outflow will come to 169,622. Under May, 185,993. And in June, 141,899. The next row is the net cash flow, which is simply the difference between cash inflow and cash outflow. So under cash inflow in April, we have calculated 117,200 cash inflow, where the cash outflow is 169,622. So if you deduct cash outflow from cash inflow under April, we are going to find we have 52,422 negative, and then under May we have 45,607 positive, and in June we have 5,301 positive. Then we start looking at the next row, which is opening cash balance. Under opening cash balance, we are guided that we had 15,000 at the close of at the opening of here. Beginning cash balance March 2023, 15,000. Supposed to be April, 15,000. So mean that in April, if we take this one to be opening cash balance, supposed to be opening cash balance, we are going to have we are going to have 15,000 in April. That was a typo. It's supposed to be opening balance in April. Assuming that this is the opening balance in April, we put it here, open cash balance 15,000 kwacha, and then we add it to net cash flow, which is 15,000. Add it to net cash flow, which is 15,000. Okay, so let me just change this one. Supposed to be looking at this one as opening beginning cash balance in April. Okay, that's fine. That is beginning cash balance in April. Okay, things done. Move on. So we come to this one, which are my focal point. So we have April 15,000. That is the opening cash balance. Then it's a positive figure, health balance in the bank, and then we add it to the net cash flow. It just goes to reduce our negativity from 52,000 cancelled by 15,000 positive. We remain with a deficit of 37,422. Now, what is the closing balance in a particular period is the opening balance in the next period. That's why you see this 37,422 becomes the opening balance in May as negative 37,402. So in May, we are going to start with a cash deficit of 37,422. But in May, there was a positive net cash flow of 45,607. So when we add these two, it gives us an ending balance, a positive figure, which is 8,185 kwacha. So as before, the 8,185 kwacha, which is the closing balance in May, automatically becomes the opening balance in June. Here's in June, we have an opening balance of 8,185. And in June, we expect to make a net cash flow, positive cash flow of 5,301. So 5,301 expected to be generated as net cash flow in June, plus the opening balance of 8,185. We're going to expect an end cash balance of 13,486. So I believe that has helped you to understand how we calculate or prepare the cash budget, especially in an exam kind of situation. So with all those workings need to be shown to earn your marks. You start with the easy or low hanging fruits, you slot them in the template, and then goes to start cracking on what might be challenging to you. What is important is to understand what the examiner wants you to do to compute those particular figures. The critical point is you to be careful and understand the instructions. The instructions are part of the exam. If you miss the instructions, you are going and misinterpret, you are likely to generate wrong figures and your cash budget won't be correct. So in conclusion, I can say that in preparing a cash budget, it is a critical component of cost and management accounting. Cash budget preparation is a critical component of cost and management accounting. Why? Because normally cash is taken to be the lifeblood of any business. You mess up with the cash management, cash flow management, your business will be terribly affected. And this requires a careful analysis of historical data, accurate projections, and ongoing monitoring to ensure the company can meet its financial obligations and seize opportunity for growth. So that marks the end of how we can prepare a cash budget for this cash budgeting part 3. Remember, don't forget to subscribe to my channel. There are more interesting videos which are yet to come for you to benefit. Also, like my channel, and hope to see you next. Thank you for listening.